Thank you, Mr. Chairman. That's a good segue because my first question is for Mr. Sears, and it's about bank regulation. Banks and credit unions play a critical role in providing access to affordable home ownership. In the aftermath of the 2008 financial crisis, regulatory burdens like Dodd-Frank disproportionately hammered these institutions, especially community banks and credit unions that are often the primary lenders for first-time homebuyers, low to middle-income families, and local developers. You talk about the American dream going away. We want the American dream. We want that American dream for home ownership, and we need lenders to create that American dream. In testimony to this committee yesterday, Federal Reserve Vice Chair for Supervision, Michelle Bowman, noted that, quote, the capital treatment of mortgages and mortgage servicing assets has resulted in banks reducing their participation in this important lending activity, potentially curtailing access to mortgage credit. Mr. Sears, given your understanding of the mortgage market and local housing dynamics, I'd like your perspective on whether reducing the regulatory burden on financial institutions would have a positive impact on competition in the mortgage lending market.
Thank you, Mr. Barr. Good to see you again.
Good to see you.
Anytime regulation can be streamlined, shrunk, or eliminated, I think is a good thing for the capital markets. We have consumers right now that are struggling to find financing, and opening it up to more credit unions, local banks, and the large national companies as well gives a consumer choice, which is a good thing.
Well, thank you, and this is especially important regarding the regulatory capital requirements and the finalization of Basel III Endgame. We're going to be watching the regulators to make sure that they improve on the previous version of the proposal, where we saw punitive treatment of certain mortgages that would have reduced lending and access to mortgage credit. Let me ask you all about, and Mr. Peter, I'll direct this at you, shared appreciation mortgages. This is an innovation that I think we ought to really consider. The median down payment for first-time buyers is 10%, the highest recorded level since 1989. Clearly, Americans need innovative solutions to finance a down payment, and one solution is a shared appreciation mortgage. Now, what is this? It's a type of home loan where the borrower agrees to give a lender or co-investors a portion of the future appreciation of the home's value in lieu of a set interest rate. Using a no-payment shared appreciation mortgage as down payment assistance can bridge the affordability gap and empower low-income or working-class borrowers to qualify for and afford a conforming first mortgage. I think we should incentivize private capital providers to invest in these shared appreciation mortgages to encourage this down payment assistance for new home buyers. One way to do this is to make the returns attributed to pools of shared appreciation mortgages tax exempt. So this would be a tax change outside of our committee's jurisdiction. But do you agree that such a tax exemption that would encourage co-investing and sharing in the appreciation of mortgages, is that a solution for affordability?
Yeah, I think it's certainly a very innovative idea, and I know enough about it to be dangerous, but I don't know all the gory details. And to the extent that these shared these mortgages can be used to go along with shorter loan terms, that would be very, very beneficial to borrowers, because then they build up equity much faster, and they have the staying power to stay in their homes, even when home prices decline.
There's an innovative startup called Homium that I've become aware of and acquainted with, and they would use blockchain technology to actually aggregate co-investment capital to help with this down payment assistance and also unlock home equity in ways that are less or more consumer friendly than, say, a reverse mortgage. So I think we ought to explore that. Let me finally get to the 10-year. Mortgages, 30-year fix, they're tied to the 10-year. It's not the Fed funds rates, it's the 10-year. So for my friends across the aisle who think we need to spend more money, more HUD money, more spending, the national debt is driving the 10-year up. If you want to really achieve affordability on a 30-year fixed rate mortgage, let's send a virtuous signal to the bond market and start living within our means. Reduce the 10-year. That's going to improve housing affordability. Not blowing up the bureaucracy and spending more money, but live within our means. Lower the 10-year. Can someone on the panel talk a little bit about this, and how does the Fed's interest rate policy and a rising 10-year Treasury yield impact the availability and affordability of mortgages, especially for first-time homebuyers?
Yeah, we've seen it during the pandemic when the Fed lowered interest rates and then slammed the brakes, and now we have higher home prices and people are dealing with higher mortgages, and it's unsustainable, and people can't afford housing. But ultimately, the implicit guarantee is also providing competition to the 10-year Treasury.
Thank you very much, Mr. Peter.
Yield back.
Gentleman yields back. Recognize the gentleman from Georgia, Scott, recognized for 5 minutes.
Thank you.